Well, welcome back. In the last segment of this, we described how to input all the income, and now we're going to look at deductions. So this is where we left off right here after we had put all the income. I could click on continue, but instead, and it would take me back. Well, let's see where it takes me. Should take me back to this screen. And this was good. I'm showing you this because remember, I said you can always go back to that question that I want to be guided one, but we're going to continue here saying select forms, or better than that, I'm going to go over here on the left and I'm going to just click on deductions. Well, it's going to make me say, I'm going to say select forms and I'll say continue. So let me explain something. We all talk about write-offs and what we can do. And before the Tax Act that Trump did in 2018, the standard deduction was a lot less than it is now. Now, what the standard deduction is everybody, depending on their age and filing status, gets a certain amount off of their income that they don't have to pay taxes on. That's the government just assumes everybody, you know, has write-offs and stuff, and they say, okay, we're just going to give you a set amount and you don't have to prove anything. We'll just assume you had that. On the other hand, if you have certain deductions such as mortgage interest and real estate taxes, income taxes, charitable contributions, medical expenses, those are all called itemized deductions. And if you add all of those up and they're more than the standard deduction, well, then you're going to take the itemized deduction. Okay. TaxSlayer, if you put in all of your itemized deductions, it will take the higher of each. However, I will tell you, not many people itemize anymore. The standard deduction for a single person this year, I think, is $12,800. If you're married, it's like $25,600. And if you're over 65, you add about another $1,700 onto that. So it's a lot of money. So unless you've got a huge amount of mortgage interest, I'm going to go over a few of the types of deductions you might have so you can understand the limits to it and think. If you're not sure, just enter in all your itemized deductions. It doesn't take that long, okay? But you can do it. So here I'm in this deduction screen. Now, what I'm going to start with is you see the first one, it says adjustments to income. And adjustments to income are kind of a specialized deduction because they're what we call above the line deductions. They reduce your income before you get to this magic number of adjusted gross income, or AGI. And a lot of loan applications and other things and other tax credits and things refer back to AGI. So it's better to get a deduction before AGI than it is after. And those types of deductions we call adjustments. And we're going to look at a couple of those. These are called for educator expenses, medical savings accounts, student loan interest. So I'm going to click on begin here. And here it shows all of these adjustments. Okay. Medical savings account, if you have one, you probably know what that's about. I'm not going to describe it here. Educator expenses, if you're a teacher in K through 12. Okay, like I was a teacher in community college, so I didn't get to deduct any of these. But if you teach in K through 12, you can take an adjustment for educator expenses. You can always just, if you think that applies to you, click here, learn more. What are some more of these things? And I meant to say, when I was saying medical savings accounts, those are rare. Really what you'll see is health savings accounts. And those are if you have high deductible health plans. Not that many people have them. They're good things to have and they're good things to learn about, but we're not going to do that. Moving expenses have pretty much gone away unless you're in the military. But contributions to SEP, simple and qualified plans. And qualified plans, they kind of mean IRAs. So if you're making a contribution to an IRA, you can take, this is an adjustment to income, so you take a deduction for that, but there's a lot of rules around there. And I will tell you, most people these days, they're using their employer plans to contribute to a 401k, and that's all taken care of on your W-2. So you wouldn't even use this screen, okay? If you're like in my case, where we did the Schedule Cs and you're self-employed, you might be entitled to take an adjustment for self-employed health insurance. Again, a lot of rules around that. So click on this to learn more if you think that happens. This screen, you're not going to have to put anything into, because if you filled out the 1099 INT right, and by the way, these are rare, but if you cashed in a CD early, sometimes there would have been like a box 3 on that 1099 INT that said early withdrawal penalty. And if you put that in, TaxSlayer is going to count it. So don't really need to worry. You might have paid alimony, and again, a lot of special rules around there, but if you're paying the alimony, you should become familiar with that, and you would use this screen here to pay that in. Here, I misspoke earlier. These were contributions to like employee plans. Here's your IRA deduction. It's separate from those, okay? A common one we do see are student loan interest deductions. So if you've been paying on student loans, you're going to get a 1099-E that'll tell you how much interest. By the way, this year for 2021, nobody's made payments on those. So nobody should be getting those this year. But that's what this screen's for. And then again, the tuition and fees deduction, they still got it in here, but that's gone until at least 2025. So these are what the adjustments are. So I'm going to go back out to the deduction screen. I'm not going to put in any of those. Say select my forms, continue. And then now we have credits. I think I'm going to come back to credits. Since I already started explaining about deductions, let's continue on with that for right now. And here's my itemized deduction screen. So let's go click there. And as I said, most of you are going to take the standard deduction, but here's one place where you're always going to want to use this screen. Is if you made cash contributions, and when I say cash, that means cash, check, or credit card, you know, like to your church or the United Way or any charities that you do. If you made contributions to those, if you are allowed to deduct up to $300 of them in addition to your standard deduction. That's on top of. 300 if you're single, or 600 if you're married. So the way TaxSlayer counts this is always go into this itemized deduction screens, and you're going to fill in gifts to charity. We'll get there in a minute. I'm going to kind of go down this list and explain a lot of other stuff. Okay. This first one is it would allow you to tell TaxSlayer to force one or the other, and I would tell you don't go there. Okay, we'll just start right here, medical and dental expenses. And you might want to click on this learn more, because I'm going to give you a brief explanation of this, right? Is medical and dental expenses, those are things you pay for doctors, prescriptions, hospitals, you know, there's a list of qualified ones. But here's the caveat, the big caveat, is they're only deductible those expenses that exceed 7.5% of your adjusted gross income. Now, you've been watching me put in my income, and I've got about $60,000 of income in there. 7.5% of that is about $5,000. So the first $5,000 of my medical expenses aren't even going to count. Now, by the way, insurance would count to that. Not if it's paid by your employer, but you know, still, if you're not sure, go ahead and enter them. And here's one more caveat, is when we get to the state of Arizona, Arizona allows 100% of your medical expenses. So you might take the standard deduction on the federal return, but itemize on the state. So again, if you're not sure, go ahead and enter those in here, okay? Mortgage interest and expenses. I'm going to click on this one to show you, because if you own a house and you've got a mortgage on it, they would have sent you a 1098, right? And this is this screen right here. Mortgage interest reported on Form 1098. Now you are allowed to deduct interest on the first mortgage of your house that you used to buy the house. Used to be you could deduct all the interest on a second mortgage, a lot of people would take out a second mortgage and pay off their credit card debt. No more. 2018 changed that. You can only deduct the interest on a second mortgage if you use the proceeds to improve your principal residence. We're going to assume you've just got one mortgage, a 1098. So I'll click on here. And the first thing that comes up right here is real estate taxes. I thought this was mortgage interest. Well, on your 1098, most people will have an escrow account, and the real estate taxes are paid by the mortgage company, paid directly, and it reports it right there on that 1098. So we're going to pretend I've got thing and that I paid $1,200 in real estate taxes. But we're not done here, because here we're going to say add the interest and points paid. So when I checked in that, oh, I used to have a mortgage for Quicken, so I'm going to put Quicken in there. What's the interest paid? I'm going to put, I paid $2,300 of interest, right? Points paid only happen in the first year of your mortgage, and that's if when you bought the house, you might have had a mortgage broker that said, hey, we can lower your interest rate if you pay some of the interest up front. And it'll say it right there in a box on the 1098, but that's only in the first year. So I'm done with this. I'm going to click on continue. I'll click on continue here. It should take me back to, it took me back to there. I'm going to hit continue here. Took me back to Schedule A interest. Remember, see how it keeps walking me back? I could have probably just gone back here to this deduction screen and say, select my forms, continue. Okay. We were back to itemized deductions. I'm not sure which is the better way to do it, but you can do it. Here, let's just go in and put some medical and dental expenses so that I can show you how it compares. So I'm going to say, I spent $2,000 to doctors, spent $1,000 on prescriptions. X-rays, yeah, had to go get some X-rays. Nursing help, hospital care, alcohol, drug rehabilitation, medical mileage. Yeah, I drove to the doctor quite a bit. I'll put 150 miles in there. You can put in other medical expenses. Maybe you had counseling. By the way, if I click on medical and dental insurance. Yeah, I paid for some. Remember how I told you on that, on my wife's Social Security statement, her Medicare premiums? Now, I think I put in Medicare premiums and they're going to carry over here automatically. So I'm not going to count those, but I'm going to say, yeah, I paid $1,200 for me too. Okay. So now I've got some medical expenses in there. Trust me, they're not going to be deductible anyway. We'll hit continue, but this way I'm going to show you when we go to do it. Okay. Now, so we got mortgage interest, taxes you paid. Now, usually the taxes that you paid would come from the W-2, the withholding for Arizona state taxes. But we're going to go look at this screen here for just a second, because right here, we're going to edit this. See, it took the $1,200 for real estate that I put in earlier. See these three dots right here? If I click on that, I'm going to say edit this, because there may be other stuff. So it says additional state and local income tax do not include amounts from W-2. But maybe when I file last year's tax return, I had to pay money into the state. So I might want to put that in here because I paid that in April. So that was paid in 2021. So I would pay that in here and deduct it. So I'm going to say, yeah, I had to pay $100 to the state. Okay. State and local tax paid. Now, here's a worksheet that will walk you through how to do that. Usually, tax layer or the federal government, they've got kind of a standard amount. And what they're going to do is they're going to compare sales tax deduction with your state income tax deduction and take whichever is larger. And they've got kind of a basic one that will give you, without you calculating and adding up all your sales tax receipts. However, if you made a major purchase like a car or a boat and you had to pay a lot of sales tax on that, you might be better using this sales tax worksheet right in here and going in and filling this the zip code, number of days you lived in the zip code. If you know how much, see, the calculation using the IRS tables do not take into account sales tax paid on large purchases, right? So you might want to put that and click on this override below. This is kind of rare, and I'm not going to walk you through this. So I'm going to say cancel this here, because this could get to them. Most of us are not paying fourth quarter state sales tax or state estimated tax payments. Okay. Here you could force it to deduct state sales tax instead of my state income tax. I wouldn't do that. Let the program calculate it. Here's where I put in real estate taxes. But a lot of you will say, don't I get to deduct my car registration? Well, a part of it, yes. You get to put in what they call it ad valorem tax, but it's only the tax that's based on the value of your car. So if you pull out your registration, the biggest number is going to say vehicle license tax, VLT. That's the biggest number, and that is deductible. And then there's registration fees and motor vehicle fees and pollution fees and a whole bunch of other little numbers, but you can't take the total. You can only take the VLT. So I'm going to put in here that I've got some VLT. I'll say $560, right? So there I got all my taxes in. I'll hit continue. I'll hit continue again here. Takes me back to itemized deductions. I was telling you that you should always put in gifts to charity. Assuming you made some gifts to charity, right? But even if you think, oh, they're not going to count, put them in. So I'm going to click here and say gifts to charity. Cash gifts to charity. Now that means cash, credit card, or check. So I'll put in here begin. And you know what? I have made a bunch of these. I do the KJZZ and Goodwill and do this. And I totaled them all up, and I've got $400 of contributions. So it says here, do you want to group all of your cash contributions into one single entry? Click the override button below. I'm going to click override, and I'm going to say, yeah, I put in $400. Whoops, not that much. Okay, and say continue. Then it says non-cash donations. Now this says more than well, I skipped a line. Here's non-cash gifts to charity. What you want to be careful of is if you're going to value your non-cash gifts at more than 500, you got to fill out a special form and you got to give a lot of detail. That's in this next one. But we're going to say, no, I just gave a couple boxes to Goodwill, and I'm going to say, oh, here's where I get to put in charitable miles. Now, I volunteer for VITA. So yeah, I drove a bunch of miles to VITA sites. I'm going to put some in there. And then I gave some to Goodwill. I'll just say I value them at $250. You may say, how do I know what to value it at, right? Well, you can click here to say learn more, and there's sites. You can go into Goodwill and say, how do I value thing? And they'll give you a list. Okay, use Levi's, $10 a pair, shoes, something like that. So this would give you a good idea of how to value those. Okay, so we're going to say continue there. If you do non-cash donations, follow the screens carefully. You got to put in a lot of information on doing that. You may have heard KJazz say, hey, donate your car to us. That's a whole special thing. And if they do that, they're going to send you a form, and here's how you're going to fill that out. But that wouldn't apply to many. So I'm going to say we're done here with deductions. Okay. Unreimbursed employee business expenses don't count anymore. I don't know why they keep it in here, because I think they expect they're going to come back. Okay. So those are pretty much our itemized deductions, and I'm going to click on continue here. But now look, here's where you could say, compare your total deductions amount. So I'm going to say here, begin. It's calculating the return. See, it calculated my standard deduction at $26,450. And man, I had put all those itemized deductions, and bummer, man, $8,700. So it's going to give me my standard deduction. However, remember the charitable contributions. I'm going to show you in a little bit where I got some extra for that. So I'm going to click on continue. And I think that's going to end this section on, no, we're not end it. We want to go through credits here, right? So we did deductions. I'm going to come back up here to the credits menu. Okay, so let's go look at credits right here. I'm going to click on edit credits. There's a lot of credits here. Okay, so here's the first one, and don't forget this one. Okay, the recovery rebate credit. Now you're thinking, wow, what was that? Well, you know, Congress passed what they call economic stimulus payment, economic impact payments. And then IRS, you have to count these up on your return. You don't have to pay tax on them, but you got to account for them. They call it the recovery rebate credit. All of us normal folks, we call it the stimulus payments. Okay, now there's been 3 of them total. The first 2, you should have reconciled those on your 2020 return. But then you got a third one. This was the big one. It was $1,400 for everybody on the return. Okay, you got that about March or April. And you should have gotten a letter from IRS saying, here's how much of the stimulus payments you got. And we need to enter that because maybe you didn't get as much as you're entitled to. That could be for various reasons. They were using your 2020 tax return to calculate whether you were entitled to the stimulus. And maybe your income was too high or they reduced your stimulus. Or maybe you had a baby in 2021 that wasn't there in 2020. Now you're entitled to a stimulus for the child that was born. So for various reasons, what we're going to do, we're going to click on here and we're going to say begin. And I'm going to show you a real good example here. We're going to say, right here, it asks you, did you receive the stimulus payments? Did you not? I'm going to say, yes, we received it. And it said, how much did you get? And that letter I talked about was called an IRS Notice 1444C. So I got $1,400 for me and $1,400 for Donna. We're going to find out when we go review our return, a little bonus is going to come up here in a minute. So we're going to say, continue with that. Then education credits. Now, these could get a little complicated, but if you've got children that are in school, or maybe you went back to school, okay, there's 2 types of credits. I'm not going to go into these screens because they get a little complicated, but one's called the American Opportunity Credit. That's for the first 4 years of college. And then the second one is called the Lifetime Learning Credit. So if you go back and you take courses that are designed to improve your job skills, you can get a different credit on that. These are things that would take too long to walk you through, and not many of you are going to take this. But if you do have these and you need some help, call the person who sent you the link for this or the number that they sent you, and we'll help walk you through those. You can also click here to learn more about these credits right over here. The foreign tax credit form, this is if you had a mutual fund and you paid taxes to a foreign country, IRS is taxing you on that income here, and then you also pay tax to the foreign country. They'll give you a credit. Now, usually that's reported on that Form 1099 DIV, and as long as you put in the boxes, TaxSlayer is going to take care of it. Okay, it gets way more complicated. In fact, it's out of scope for us to help you with taxes that were directly paid to other foreign governments, and I would suggest you get professional help for that. Look at this one here. This is a huge one for this year, child care credit. We're going to go look at this because if you had to pay, this is also called, it's really called the Child and Dependent Care Credit. So if you had to pay for a caregiver, either for your kids or maybe for your parents, so that you could go look for, or so that you could go work or look for work, this credit was expanded a lot this year. And I meant to give you an introduction to credits. While this is loading up here, I'll do that. There's 2 types of credits. There's what's called non-refundable credits and refundable credits. Non-refundable credits, they're better than deductions, okay? Because they don't just lower your taxable income. They actually pay part of your tax, dollar for dollar. But a non-refundable credit will only pay the tax that you have on the return down to 0. And if there's any left, it won't use it. It can't use it. A refundable credit will bring your tax down to 0. And if there's any left over, it adds to your refund. So refundable credits are better than non-refundable credits. And now the screen's not working. So I'm going to go click on deductions again here and see why it's not letting me get into the credit screen. So I'm going to credits. Let's try this again. Now it worked for me. I don't know why that. So, oh, I was going to go into the child care credit screen and show you. And for some reason, this seems to be giving me a problem, but I can describe this pretty close. What I was describing is those credits were greatly increased, okay? You can claim a credit up to $4,000 per child for a maximum of two children. So that could be up to $8,000 you paid for childcare, which childcare is expensive. You may have paid that. It used to be only like $2,000 last year, was nowhere near as much. And then last year, this credit was a non-refundable credit. And this year, it's a refundable credit. So if you paid anything for childcare, be sure you go into this screen and do it. And there's two pieces of information you have to enter here. You have to put in the total amount paid to the provider, and you've got to put in information to the provider, including their name, address, and tax ID number. If you paid a nanny, well, I'm not going to say that. Let's just assume you went to childcare and you paid that. Maybe you had to pay somebody that came in and cared for your elderly parents, right? And they should give you a form at the end of the year saying, here's how much you paid. Here's our tax ID number. Here's our name and address, because you've got to fill in that amount. And then you have to say for which dependent it was paid for. There's two parts of the screen. It's not going to let me into this screen. So I'm going to go back out here. But the screens are not that difficult, but be sure that you put that in and don't skip it just because you didn't get that before. Let's see if there's any other credits we should go over here. Okay. Investment credit, residential. The residential energy credit for is if you paid for a new air conditioner or water heater that was energy efficient, there might be a credit there. So be sure to look at those screens. Here, this one is a lot. If you had to take off work to care for yourself or somebody else because of COVID, and it was in the first 3 months of 2021, you may be entitled to a credit. If you think that applies to you, call us and we'll walk you through that to see, okay? There's a retirement savings credit that usually that comes from, it's really only for lower income people, but if you contributed to a 401k plan and we put it in under the W-2 correctly, TaxSlayer will calculate that. If you were lower income and you had contributed to an IRA, we might could take another advantage for that, but I've almost never seen that. There's a credit for qualified electric motor vehicle credit. That would be rare, but like when I bought my Prius, I was able to get that credit. You know, you don't want to miss out on that too. Okay, so that's basically the credits menu that I wanted to take you through. So good. That takes us through deductions, and I'm going to end this video with that one. And when we come back, we're going to look at how to finalize the return. So see you in a little bit.